time in the market beats timing the market. You've probably heard this or some iteration of this investing proverb. And this idea of avoiding market timing altogether has become a sort of religion among investment circles. In fact, when clicking on this video, you're probably guessing that the answer was going to or is going to be no. Well, I'm here to tell you that it actually depends. The real question to ask is, why are you timing the market? If your answer is to increase returns, then timing the market may actually not be the most efficient way to do this. In fact, it could prove to be detrimental. Besides, there are other ways that can be potentially better for this. And unfortunately, it does require the ability to take on additional risk, which is probably not the reason why you're clicking on this video in the first place. If you're watching this, it's probably because you're anticipating a market downturn at some point in the future. And I get that. Downturns can be uncomfortable business. I too, like everybody else, worry about a painful scenario where 30, 50, or even 80% of my capital gets wiped away. And if there's some way to avoid it, personally, I'm all ears. That's why I think that if your goal is to attempt to avoid a catastrophic scenario, then market timing could potentially make sense. But how does one exactly go about doing this? Alright, before telling you why market timing could be beneficial, let me tell you why it's been said that it doesn't work. And for this, I'll utilize the most well-known and simplest argument against it. What would happen if you missed the best days in the market? You too have probably seen or heard about this, where you've seen a chart like this one showing you that missing even the top 10 days in the market could lead to detrimental results. In this case, JP Morgan ran data from 1995 to 2014 that was then published in Business Insider, showing you that missing the best 10 days in the S&P 500 brought paper returns from 9.85% down to 6.1%, meaning that $10,000 invested could have resulted in $32,665 instead of $65,453, cutting your return by roughly half. Yikes, that is actually bad. And if that's what market timing is all about, then yes, I think it could make sense to avoid it altogether. But the next natural question would be, do you actually miss the best days when timing the market? And the answer is that actually, yes, there's a good chance you could miss the best days if you market time effectively. And that's because the best days actually tend to clump together with the worst days, which are actually the days that you're typically trying to avoid. In the article, Avoiding the Market's Worst Days Beats Chasing the Best, Lance Roberts shows you how daily market volatility, meaning the largest up and down days, tend to show up at its most extreme during market downturns. As you can see, the biggest spikes representing big market moves have historically clumped together during bear markets. So if you were to market time and successfully avoid these bear markets, you would likely have missed the best days. So, Jose, does this mean that if you sell right before a bear market, you get less returns than if you were to buy and hold through a downturn? Well, no. Not even close. But this does beg the question, what is it that you get in return by giving up the best days, assuming they occur during a bear market? Well, logically, if by avoiding bear markets, you avoid the best days in the market and the best days and the worst days are clumped together, then it makes sense that you're avoiding the worst days too. So what happens if you avoid the worst days only? Actually, according to Roberts, you would make an absolute killing by avoiding the worst 10 days only. In fact, it's not symmetrical. It's far better to miss the worst days than to preserve the best days. Of course, it's actually impossible to constantly and accurately miss the worst 10 days. It would take a great deal of luck to make this happen, just as it would take an equal amount of unluck to miss the best 10 days. So this is why the whole best days of the market argument doesn't actually quite make sense to me. Think about it like this: if you can successfully avoid a bear market, you tend to avoid the best and worst days, which logically means that you're actually dampening volatility. Not just that, but you've avoided a bear market, which is the reason you're probably market timing in the first place. Well, that sounds like a great deal. What could go wrong? For starters, avoiding a bear market is no easy task. And I'll agree with the argument that says you cannot do this 100% of the time with 100% certainty. Additionally, if you sell before what you think is a bear market, but it is not, you're likely hurting your returns. So let's go back to the drawing board and ask, is there any tool that could help us market time effectively? In the paper, A Quantitative Approach to Tactical Asset Allocation, Faber explores how a rules-based trend following system performs as a risk management tool. He utilizes a 10-month moving average rule and compares it to a buy and hold system in the S&P 500 from 1901 to 2012, and finds that the timing model has produced slightly better returns than buy and hold, but has done so with much lower volatility and shallower drawdowns. Similar studies conclude similar findings. And trend following is a simple investing strategy whereby if an asset is going up, you are long, you are buying, you are bullish, but if it starts going down, you start selling. And the idea is that at some point you successfully sell before a true bear market and are able to save your precious capital. Now, this is done using rules that are hopefully very simple and look at the long term so that one avoids having to constantly trade. And this leads me to the first rule of market timing. Market timing cannot be discretionary. Selling when you're fearful and buying when you're greedy just won't cut it. You must ignore how you feel and blindly follow these rules in order to remain objective and have a successful trading system. Otherwise, don't even attempt to market time. You'll likely just get hurt. Rule number 2, trend following is not perfect. The point is not to sell at the tippity top and buy at the very bottom to produce great returns. A good trend following system actually won't ever do that. Usually you are selling when a good amount of fear has already hit the market and you're buying when bullishness is well underway. But that's okay. The point is to avoid the major losses, not to sell at the top or at the right time. Remember, we want similar returns to buy and hold. We are not looking for better returns with less risk. That is a fool's errand. Rule number 3, trend is a loser's game. Okay, maybe I'm being a little bit harsh, so just let me clarify. When trend following, 70 to 90% of the time, anytime a signal tells you to sell, you'll likely lose, meaning that you sell, the market roars back up, and the next signal tells you to buy, though this time at a higher price. This right here is the main drawback to trend following, and not something that's really fixable in my opinion. See, trend is positional, not predictive. It prepares you for a drawdown. It doesn't necessarily predict it. But Jose, if 70 to 90% of the time you lose when trend following, how could anyone get ahead when implementing it? Well, trend following is all about power rules, the math of outliers. Imagine you face a 50% drawdown. At a 7% return per year, it would take you 11 years to get back to even. But if you were to implement a trend following system that instead made you lose, let's say 15% only, at 7% returns, it would only take you 3 years to get back to even, which is still painful, but not as bad as 50%. Remember, with a 50% decline, your portfolio must double before you can get back to even. That is, you need to realize a 100% return. With a 15% downturn, you only need an 18% return to get back to even. And that's why trend following can't work. To give you a baseball analogy, trend is like a batter that misses 70 to 90% of the time, but the one time he does hit, it's a home run. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.